Hello.
Oh, hello. Good afternoon.
Good
12:00.
afternoon. Exactly. Hi, Sophie, and hello, everyone online as well.
Hello, Minna.
Welcome to the 12th Flourish Financially Money conversation. Very nice to see
Yes,
you.
pleasure to be here indeed.
Exactly. My name is Minna. I am so pleased to be here again with my fabulous co-host, Dr. Sophie. And today we are diving into a topic that feels incredibly timely: how to make investment decisions in uncertain times.
Yeah, what a topical topic, if I may dare say, if I dare say. So yes, hi everyone. Hi Minna. So nice to see you again. Pleasure to be here. And I was actually thinking, there are so many people that I hear that say now is not the time to invest. Things are too unstable, and yet I was reflecting, and I think this is what we've been discussing, that if we only act when things feel stable and certain, then we often miss real opportunities. So today we're here to talk about exactly that. What principles can help you, can help us to invest wisely when the world feels anything but stable?
Exactly. And also, for those of you who are new here, welcome. Flourish Financially is our growing community where we talk about money in a grounded, smart, and emotionally intelligent way. We try to mix solid financial guidance with the key psychological tools so that you can build both wealth and financial well being. And it's very nice to see the hellos from the
Yeah,
community. So
show them
please
briefly.
use, very good. Hello, everyone. So you can use the comments in on LinkedIn, and we will then be able to put the answers on the screen here as well. So it's very nice to keep this. Hi, Julia. To keep this very engaging. So please feel free to do that, and we will also ask some questions as we go through this.
Yeah, to make this as interactive as possible. So, anyway, as you said, we're gonna be drawing on investing principles, but also on insights from psychology. And in particular, there's this book that some of you may have read already, which is quite good, from Morgan Housel. And he's researched psychology of money. So some of the psychological principles are taken from that book, but also we're going to show you a few other sources of information. So what about navigating a world that feels very VUCA at the moment? So I'm going to use this acronym. And VUCA is about volatile, being uncertain, being complex, and being ambiguous. And
Exactly. The
this is
VUCA
gonna
world
be
is indeed
what we're talking
indeed
about.
the case. So let me just put also our slides here so we have that ready. Very
Yeah.
good. And I would also kind of maybe start with a little poll. So, given that there has been quite a bit of volatility in the markets lately, how have you reacted and felt about it? Let's put it also on the screen
Yeah.
there. So, what has been your reaction? Option A: what stock market volatility? Option B: I'm scared and panic. Should I sell everything? Or C: oh, I'm just observing, eating my popcorn, and sticking to my long-term investment strategy. Or D: finally, the prices are down. I can't wait to go and buy more stocks from the market. So would love to hear if you have been active and following this. What has been your reaction so far?
Yeah, I must admit I got a bit of a freeze first, and then I was more in the mood of D. Ah, okay, so it's a good time to buy. but these are just my
Yes,
okay.
exactly. I think there has been, Anna is saying observing, very good. Sticking to the long-term strategy and staying cool, that's always
Mhm.
very good. I've also gotten a lot of people who are excited to buy more, so using this opportunity.
Mm.
But
Thinking.
also some who have been saying that there have been also confused or feeling scared. It's quite normal, right? Also to be feeling like
Gotten observing again. That was C from LinkedIn user, and yeah, somebody thought indeed
good
time.
time to buy. Yes, somebody's buying. Very good.
Okay.
Adrienne, see, observing.
Mhm. Okay, so
Very
we
good.
have some winners here, it sounds. And here
Yes,
again with Judith,
good.
we see.
Observing and on the other hand, buying, taking the opportunity.
Mm.
Okay, very good.
Okay, so we have seasoned.
Seasoned investors on the line. Very good.
Nice, very nice. Although, yeah, being scared is also normal, right?
Yes,
We're gonna
absolutely.
do that.
Christina saying A and D, and someone else anonym also C. Yeah, very good. Very different reactions. Very good.
Good. Mhm. Okay.
All right, so let's start with our first topic. I'm going to just put the next slide. The VUCA world, right?
Yeah. And about this key question, why the world feels so crazy. And before we talk about what we can do with our money, Minna, we thought that maybe we're going to take a moment to talk about the world we're living in. Because for many of us at the moment, it feels, well, a bit like chaos to some extent. And we feel like there's one crisis after another, with market jumps and plunges. And I'm sure you will comment on that also with the latest events. And to be fair, from a psychological perspective, our nervous systems are constantly on alert. So this is what happens.
Yes, exactly. I mean, well, you probably read the news, right? These recent actions from the US have left everyone around the world in shock. And what has kind of happened a bit is that this kind of trust that we had in our system of kind of the global trade that has been working well, or even our defense alliances, that trust has now kind of been shattered. And kind of to get back to a good place, it will probably require some work and some patience to repair this. And these actions, I mean, we have not really had a trade war since in a very, very long time. And that's kind of also what got, I think, this very strong reaction. It felt like, oh, this is unprecedented. And yes, this is exactly typical for this kind of VUCA environment, right? So originally, of course, this term, this VUCA, comes from a military background, right? But it's also now used in leadership, in business, in financial planning, right? So volatility, uncertainty, complexity, and ambiguity.
Yeah, and we did a bit of research on that, just to see what's been said out there about what we're supposed to do when we are in the VUCA world. And then we added our own layers of what it means from Flourish Financially point of view, if we can say like that. That's what we're sharing today. So let's unpack perhaps each of those in turn, not just in theory, but in terms of how they affect our investment decisions and what are the psychological responses that are happening in such an environment. And then we can look at what to do in practice, right? With some pragmatic advice. Love it. So maybe we can start with the V for volatility.
Yes, so volatility is a term that is very familiar for those who are investing a lot. It is about frequent and unpredictable changes, so both up and down, right? And what has kind of happened now after 2 sort of relatively calm and positive years in the stock markets, we had this kind of shock reaction to the announced tariffs when they came out on the 2nd of April, right? Very strong reaction, right? The global stock markets went into correction, so meaning a more than 10% loss. And there were daily strong swings. And then now the latest move, right? Just yesterday, Trump then announced a delay of these tariffs. And those of you who have checked the markets just this morning, now it's actually jumped up again, not all the way back up to where we were before this. But this is just really strong swings in a very short time. And, emotionally, it's quite destabilizing. When we are talking about investment, we would rather like certainty, right? Predictability, probabilities, right? But when these things happen, like the sudden drop, our instinct is often to act fast as well. And very often that quick reaction is, okay, I need to get out of here. I need to sell everything and stop the bleeding of my portfolio, right? But this kind of extreme reactions are rarely the right thing to do. And yes, indeed, who knows now what will happen after this, but those who actually sold now at the bottom right now, we're again back up. Yeah, it will be very difficult, right?
Yeah, it's kind of the trap, right? Because volatility is really accelerating our threat responses. So we've all heard, not just in coaching, but this idea of like the fight or flight brain. And in fact, what we know now in time, and that's something to be thinking about, is that successful investors need to engage in the reflective brain more than just the reactive brain, obviously, the one that can pause and assess. And so what could be the strategy here is, I mean, some have said, like, as we're going to show, there was this article about what to do in VUCA environment. So that's one article from 2014. So, but one of the things to do about the V, so the volatility in particular, is really the idea of building in slack, so building in financial buffers, liquidity cushions, and margin for error. So it's not necessarily the time to act fast, rather to rely on these margins and buffers.
Yes, and from a kind of investment perspective, that could actually mean also holding more cash, liquidity buffer, right? So you have some flexibility that you don't kind of need the money urgently, right? And of course, also of having a diversified portfolio, right? And having the proper asset allocation, right? Not being fully invested in risky assets if that's not suitable for your personal risk tolerance, right? If that makes you lose sleep. Planning for turbulence is not pessimism, it's actually prudence. And we all know from history that turbulence is part and parcel of investing in the stock market. So it's guaranteed almost that some turbulence will come along in our way. We just don't know exactly when and how it will come.
Yeah, which is not freeze, right? It's more that you would have had anticipated earlier on that you're able to have that margin, so that when the volatility is coming, you're not just reacting, but you're not also frozen, right? You're just intentionally waiting in a way, which is a bit different. Okay, so let's move to the U, perhaps, which is uncertainty. So it's not necessarily in the order of that square, but uncertainty is about you understanding the drivers of what's happening. For example, there's a pending election coming, or there's a policy shift that's going to be decided, but you don't really know the outcome. So this is psychologically a little bit hard, because we don't feel like we can control the outcome, although we'd like. Probably we have a preference perhaps on the outcome. And when there's intense uncertainty, what happens is, again, our fear and stress is triggered, and it makes us feel out of control.
Exactly. And when people feel out of control, they often try to regain it by doing more. So we have an action bias as humans. We want to read more, we consume more news. We are like eager to make that trade. We're trying to get ahead of the market. And this fear can also, in a way, fix our attention on the negative. It can like amplify like the negative perception that we have, right? And sometimes it's interesting. It actually makes us like more sensitive to social signals and impedes our ability to think flexibly and independently. So what this means in the world of investing might be that you could be like looking at kind of what are the stock market gurus saying? Are they saying now to buy or sell, or what should I do? Like thinking that someone can give me that right answer or the guidance to do the right step. But the reality is, of course, even the experts don't know which direction the market is going to go. Nobody knows that. And we humans don't like it.
Yeah, and what you're describing here, this kind of overactivity almost, it rarely leads to clarity. So again, if we look at this graph here, for example, and some of the participants can find the article if they want to read it. It's quite short, by the way. In uncertainty, the best strategy might be to invest in information, but again, is not at that moment to get really agitated and consume, but rather intentionally, preventatively, to invest in this information. What could it look like? It could be our own education in becoming more financially literate. And as many of us know, the more we know, the more we don't know. So maybe we can then be a little bit more conscious and aware of what you just said, which is that actually there's not a necessarily fully right or wrong answer. And so any guru or people that are trying to convince you otherwise is probably, you can also add your own pinch of salt on that and try to stay with your own critical thinking. So psychologically, it means at that moment when this happens, right, you're trying to calm the inner noise, which is gonna happen probably because we're humans. So this is what happens. And what we do, for example, when we work with clients, we try to shift the thoughts from having a lot of negative thoughts that are around this reactivity. So I don't know what's going to happen. I can't act. I don't know what to do. To things that are more chosen thoughts and that can help you, that can support you. So I can't control the outcome, but I can decide what to do now. I can respond intentionally. And that is really key because it restores agency.
Yes, I love that. And I'm going to put one comment from the audience. Judith saying like yesterday was a good time and today it's not so good since it went up again. So this is exactly that in a way trap of kind of thinking that we can time the markets, right? That we can be there exactly at the right point. And yes, of course, it's true, right? You were not able to buy your stocks like at a lower price yesterday than today, for example. But it's so difficult, right, to get that timing perfectly right. It's almost impossible. So it is hard.
Thanks for being so engaged, dear audience. Please don't hesitate to add your comments in the comments box.
To hear about how you're doing with it.
Let's move to the C.
Complexity. So complexity means there are many moving parts. So we focus now a lot on the tariffs, but that's only just one part of it. Then there are like these second degree impacts. Like, okay, what is the tariffs going to do about inflation? If inflation goes up again by raising prices in the US and also elsewhere in the world, that can then again have different implications, for example, on the interest rate. And when the interest rate reacts, right, then there are like implications to the whole world economy, right? Or you could think about the geopolitical implications, like the new alliances that may be forming now. There was some news about Asian countries, for example, trying to form their own alliance. So it's just so many things that are linked to this, right? It's almost overwhelming, right? How they all connect, we simply cannot foresee like all those influences, right? And this kind of overwhelm often leads to kind of paralysis, right?
Yeah, no, that's really interesting, and this is where we see clients getting stuck from overthinking, because you're conscious of the complexity, but you're trying to get it all into your brain and analyze it at the same time. So what happens very often is then they feel like they need to understand everything before doing anything. So we're going more towards the freeze, right? And from psychological standpoint, also we see that this can be a form of perfectionism, almost trying to really act perfect, and it's rooted in fear.
Yes, I mean, what can work against this? This Harvard Business Review article, I mean, they recommend kind of simplification, right? Perhaps restructuring your approach in a way that you almost try to focus on only those variables that really matter to your own situation, those things that you can influence. They can be things like, your time horizon, the buffer, financial reserves that you have, your savings rate, your investment strategy. These are things that are in your hands. What happens in the world economy and the politics, that is far from that. So actually, even some advice is simply to like stop reading the economic news, like simply focus on your long-term strategy, because it's anyway so much out of our control. Of course, that depends, of course, on your personal preferences, right? But simplification, focusing on the key things that matter to you, I think that's quite good advice.
Yes, it's very interesting, and it's so complementary, because you also then can help yourself psychologically, try to really encourage yourself. So there's a name for that, the bounded rationality, but it's this idea that you're working on acceptance. And in that case, it's accepting you don't need the perfect information to make a good decision. What you need is more a decision-making approach that works for you. So this is again something, in a way, you would need to anticipate before being put on the spot. But at worst, I would say, when you're facing this situation, try to support yourself in telling yourself, having the right thoughts, that indeed what you were saying in terms of the strategy, you don't need to be knowing everything. You're knowing enough to make the right decision for you, for example, if this is what you want to do. So
exactly. And let's go still to the last one, which is ambiguity. Maybe the trickiest one, right? So ambiguity takes it still a step further. It's when even the cause and effect are not clear at all. Like it's just uncertain. It's unknowable. Like this could be a bit more, even more kind of unknown things. Like think about the early days of COVID, when we didn't know like at all like what will happen in this world. Or we could maybe think now about the emergence of new technologies like AI, if like that has like suddenly some really drastic change. There's just simply no precedent, right?
yeah. And again, I mean, ambiguity is going to lead to more freeze responses. What can happen is that people then end up delaying endlessly their decisions, is a form of default to inaction. And this can be coupled with a sort of emotional looping. So what if I'm choosing wrong? What if I regret it? So yeah, a lot of that.
Yeah, it's a good suggestion, actually, this like experimenting or taking like small steps that are also like not going to impact your entire financial situation, right? Testing, learning, adjusting. We can't wait for certainty. It may never come. But on the other hand, yes, I would be careful with these extreme actions like, oh, I'm going to sell my entire investment portfolio because the world is now going under. Or also, on the other hand, betting on a big rebound, right? Because these are the extreme ones, the extreme actions that you are likely to regret later, and also very difficult to reverse them. And I'll also take one comment from the audience from you, also not act fast on buying. Yeah, that's a really good one, because yes, indeed, like if you are like spot on with your timing, you might be able to capture kind of an opportunity to invest at a better price, right, at a lower price. Yet you don't know if there's going to be another 20% drop ahead, or is it going to be going up, right? So in some ways, you need to have this framework clearly in your mind that, okay, I am now taking a decision to, for example, try to capture some of these opportunities, but I really don't know what will happen. There is just no way to get the timing perfectly right. If you have got the timing perfectly right, congratulations. It's probably not due to your skills, but luck. So sometimes you get lucky and you just happen to suddenly have a lot of, I don't know, cash available from your savings, and you manage to time it right. That happened in the COVID one, where stock markets crashed. Some people exactly were able to time it right. So yes, it can happen, right? But it's not something that you can really rely on or think that it's because of your own skills, but it's more likely luck and just, of course, readiness, right? Being ready to act when an opportunity presents itself.
Yes, and it's interesting because it really goes against the idea that many people have about what it is to invest in the stock market, right? That it's this almost the casino, right? Which is why people are sometimes scared. So in a way, it's much more about being intentional, really intentional. So that's the strategy. You decide in advance when you're going to buy, when you're going to sell. And then you take care of your own emotions when life happens, because life will happen. So that's where is this flexibility, adaptability, agility. So is really something to be cultivated, and it's closely linked to resilience. So that's a lot what we're talking about also in Flourish Financially. It's also about being financially resilient. So it's less sometimes sexy than what some people think it is. It's also less dreadful. It's actually very comforting in many ways. But to go back to this topic of here ambiguity, so we can close on the VUCA, here we can help also with coaching or in our approach to the program of Flourish Financially to design some small low-stakes experiment that people can take with their money. And that's how, by learning from these small experiments, you're really developing your psychological, really the flexibility, right, of the brain. What we're talking about, this plasticity that we hear a lot about. And it helps in time to build the self-confidence that you want, because everybody wants to be confident. We just seems to don't know how. So that's one of the strategies. Yeah.
Yes, exactly. Yeah, I really love this. Like, when we are in this VUCA world, we don't have to be these superhero investors, right? Yes.
Yeah, what we need is a strategy. So we need both a structure and flexibility, and you need the mindset to support you on your way, and that will enable you to act even when you don't have the perfect foresight.
Exactly. The goal is not to have a crystal ball to know whether the markets are going up or down, but it's to have a compass for yourself, something that keeps you steady when the fog starts rolling in.
So good.
So, yes. So let's go now to our next
yes
part.
Bring in the banner for that.
Yes. So this is about the timeless principles.
Very good.
How do you avoid making these panicked or poor decisions in this VUCA world, right? By holding on to the timeless principles of investing. But we thought we are going to do this in a bit of a fun way today. So calling it the 7 ways to lose money in the stock markets through investing. So here are great 7 great ways how to lose money, or you could choose to do exactly the opposite, right?
I'm going to play the devil's advocate in that one. So you will hear me say things that maybe you've also felt, you've also thought, and we're going to see what advice we can get from best practices, right? Statistics and long-term strategy.
Exactly. And these are some of the fundamental principles that are really grounded in evidence, grounded in behavioral science as well. And yes, most importantly, they work. So we wanted to do this a bit engaging as well. So we're going to go through these seven ways to lose money, or what you could do instead. And when we go through it, we would love to hear from you as well. Which one of these you relate with, or you believe in, or which one has felt challenging perhaps for you. So please feel free to add comments to the chat as we go along. It's always fun to hear how you've thought about it. So let's go, right? Sophie, what is the number 1 rule?
So number 1 rule is about panic when markets drop. So what does it mean? When there's market turbulence, go in panic mode and react really quickly and based on your emotions.
Sell everything. Let fear take control, right?
Let fear take control, yes, right.
Or what you should do instead? Stay calm, of course. Continue investing, right? Even when the prices drop. Losses are part of the journey when you're investing in the stock markets, right?
Mm-hmm.
This is what you signed up for when you started investing, so it's going to come, you know that. Being resilient always beats being reactive, right? You know, you would think that the markets are really crazy today, and yes, they are at a very high level of volatility, but we humans have such a short memory. People also thought that the markets were going absolutely crazy back in 2008, 2009 in the financial crisis, or in 2020 when the COVID hit, or in 2022 when inflation and the Russia-Ukraine conflict was going on. We have seen this before many, many times. You know, every time there is some major stock market turbulence, we think that everything will just fall apart. But the volatility is simply a part of the process that you need to be comfortable with when you're investing. And to cite some statistics on this, I saw this research by Piper Sandler. They actually took a look at the US stock markets for a very long period of time, since the 60s, and they recorded like all the corrections, so declines of more than 10%. So in this period of time, right, there were 27 corrections, right? One on average, one about every 2.2 years. So they do happen quite often. And yet, if you look at the big picture, the US stock market has produced about 10% average annual returns over the long term. So it happens every few years. We don't know when exactly. Just stay invested and stay calm. While this may be painful in the short term, we will get through it. And already now we can see that the downsides of the tariffs are starting to be recognized. There will probably be negotiation. You know, we will get through it, right? Markets eventually recover and logic prevails, and, you know, companies adjust their strategies. So staying invested and waiting it out is the best strategy for most investors.
I love that. I'm going to make a comment from the psychological angle, and we also have a very nice comment from a LinkedIn user. We can't see who this is, but it's the long game that counts. Exactly. And my comment was about taking a step back, because this is really, when you're saying stay invested, I'm also thinking in terms of taking care and honoring your emotions, because when something happens also in life, not just in the question of investments, that's really the best advice, is to be able to take the step back where you're getting through the emotion of what is happening and at the same time staying intentional on what's your next step. And that's really so important. So long game, large perspective, if possible. And of course, it's not easy. That's also what happens.
Very good.
Okay.
Let's go to the second one, right?
Yeah, let's do rule number 2. That's about following the herd. And so when everyone else is investing, buying like crazy, or selling like crazy, imitate their behavior and invest without questioning the foundations. So I want to copy everyone else. I want to jump on trends. If everyone's buying, you should too, right, Minna?
Yeah, well, probably not, right? So this kind of herd behavior, it's very typical for the stock markets, right? So if you can keep instead your head cool when everyone around you is losing their heads, if you can wait and be patient and not react emotionally, then indeed there can be good opportunities also to buy out there right now. And this is the famous Warren Buffett quote. Most people have probably heard it: be greedy when others are fearful, be fearful when others are greedy, right? So following this kind of herd behavior often leads you to actually buy high or sell low, like kind of at the wrong moment, right? And I do think it's important to keep your own perspective, not just accept any wisdom on stock markets as the absolute truth. And of course, staying calm and sticking to your diversified long-term strategy is always a good idea, right?
Yeah. And again, I want to add here again, this we go back to this very basic principles of this coaching support. You know, you're talking about strategy, you're talking about staying calm, and I would say let's be intentional and let's be mindful. So you're both intentionally having the strategy, you're also being mindful of what's happening to you when it's happening to you, and it's going together really, really well. We got a nice comment here. It's Claire Corbett. Yes.
Hello, Claire.
Hi, Claire. Now we know. I think we have
you.
1 or 2 LinkedIn users. So might
Yes,
all
sometimes we don't see the names. I don't know why that happens, but yeah. Thank you for that.
Great. So let's go to rule number 3, perhaps. So that's about betting it all on one thing. Please invest all your money into just one stock or one asset class. Yeah, it's more simple. So one meme stock that can make you a millionaire. Please choose one that can make you a millionaire. And well, if it doesn't work, at least you quickly get back to zero. So that's simple. It's either or. And you can decide also choosing just one stock or maybe one new asset that you don't really know much about. In fact, you only live once. So
yes, so indeed.
what do you think, Minna?
This is a great way to lose money through investing, right? So what is the principle about? Of course, we're making fun of this, but I mean, this is the real thing, right? This is about diversification, right? So if you ignore diversification, this is really at your own peril, right? So it is the key to minimizing risks in your portfolio. It protects you against this unpredictability of the markets. And diversification is maybe a bit boring, you could think, because of course it's not like this attractive, exciting bets where you can get like the absolute highest potential returns in any period, but it's also the smartest way to keep the risk under control, at least somewhat, right? And academic research also speaks for it, right? So if you're doing this kind of broad investments in diversified, low fees, ideally index funds or ETFs, for example, divided among the different asset classes. So you have there like world stocks from different countries, different sectors, bonds, right? You could have also real estate or commodities, precious metals. You're diversifying again across different assets that can help you protect you at least some of the consequences of these downturns. Of course, when there is the big crash, then probably everything might go down at the same time. But we could just look at this extreme experiment now with the tariffs that happened. If you just were invested in the US stock market, for example, because the US stock market has been doing well in the past, they declined by more than 10%, maybe something at 12, 13% when they were really at the bottom now, just 1 day ago, right, or 2 days ago. If you instead invested in a basket of global stocks, 60% and 40% bonds, so you were holding not only US, but international stocks as well, and you have both stocks and bonds, they also went down for sure, but only about 6 to 7%. So that decline is just much less than if you're focused in one particular asset class, right?
Very interesting. I'm thinking here, balance. Obviously, that's in the end what helps. And also being intentional in wanting to keep your nervous system calm. So it might feel boring, but maybe you're making
but it works.
That is gonna keep you in balance also internally. So yeah, it's interesting.
Let's go to the next one, number 4.
Yeah, number 4, but exactly. So it's about number 4 is about make it exciting. So I would say let's forget about making an investment plan and deciding on asset allocation. Just follow your feelings, follow your really just your intuition and invest based on the mood of the day. That's nice. And don't waste time planning. Just keep it. Go with your gut. That's more fun. And treat investing like gambling. You want a thrill. You want to feel a high. So yeah, that would be the rule number 4. What do you think, Minna?
Yeah. Well, again, we reverse that one, right? So, of course, if you are interested in gambling, by all means, go to the casino, right? And you can do that in the stock markets as well if you want. But yes, if you want to kind of bring good returns over time, that kind of good investing is a little bit boring, right? It's not exciting like playing at the casino. Not trying to buy and sell and all the time, right? Developing a solid plan, applying it over time, that's where wealth grows. And some people now are asking, kind of, oh, well, is it now the time to buy? Or did I now miss it because I didn't do it yesterday? Or, yes, I mean, these things, of course, they are, if you compare with the prices, let's say a few weeks back, there are like maybe bargains out there. Good opportunities could be there as well. But yes, thinking that you know what the future will bring is quite dangerous. So there is no way of knowing when exactly the market will bottom. Maybe now we have a recovery, but it's possible that there is a future fall ahead. If there is a protracted trade war coming, or really even a recession, right? Or we could come back quite quickly and speculating about this, which country or which industry will rise and fall. I mean, it's just super difficult. Right.
Yeah. And I think what is interesting again is this idea that you can decide that you would want to do it purely by luck. I mean, this can be a choice, but again, what we're trying to say here is do that intentionally, I guess. If you want to go to the casino and you want to ensure that you don't lose everything, you can go and have decided in advance, right? This is what I'm going to do. This is how much I'm willing to actually play that day, that night, knowing what it means, right? So it's always about framing. And I think it's something that's, again, very much mirrored in a lot of the coaching approaches, because you may want to also, for example, not be completely in control of, I don't know, your time or how you want to yes, spend, I'm thinking about time, but you can create that intentionally. You're creating the pocket of time, you're creating the environment, you're creating the opportunity to do that, but you're not just putting all your future intentional hopes into that. You're knowing that, yes, no, I'm gonna do that, but also I have another proportion that's on doing something else.
Yes, I mean, this is something actually for stock markets. Yeah, some people like that they make it a bit more fun with a part of their portfolio. So they have maybe 10%, which they consider like a bit more play money, where they like, buy and sell and do more bets in a way. And it's a limited part that you do it with, like, totally fine, right? And maybe you can learn actually something when you do that, right? So all good, but maybe don't bet all your pension savings, let's say, on it, right? So keep it limited. That's a good advice. All right, okay. Actually 5, let's go.
Anybody wanted to react on some of the first 4 advice that we gave, or counter advice?
Have you been already following them, or is there something that's difficult?
We're gonna go through, and if you want to react, don't hesitate. So rule number 5 is about what you were saying in other points of this conversation, Minna, is about trying to time the market. So then it's something like certain people getting super obsessive over the news. So I can do that too. I want to be super obsessive. I want to follow I'm going down every rabbit hole. I try to really, I know I'm going to be able to buy at the bottom and sell at the top, yes, by doing that. And yeah, it sounds smart, but yeah.
But yeah, well, I mean, a lot of really good research actually show that private investors, but even the professionals, rarely get the timing right. And long-term investing actually beats this kind of market timing almost every time. So don't fool yourself into thinking that you can now get out of the stocks and then jump back in when the market is more stable, right? These kind of moves, right, are quite risky, because historically we have seen that also the stock market gains, right, when the market goes up, they also come quite unpredictably, right? And sometimes there's a big advance that comes very soon after big days of declines, like just now is actually happening, right? So there were big declines and suddenly up. And if you're out of the market, what happens often is that you may also miss the best days. The market increases, right? And research from JP Morgan, for example, shows that if you missed the 10 best days in the stock markets in the last 20 years, you would have reduced your returns by more than 40%, actually. So interesting, right? Very important for us to stay invested, so not sell everything. Remember that any losses in your portfolio are actually not real. They're not realized until you sell. Otherwise, you just wait it out, right? And at some point, the market will recover, right?
Yeah, very interesting. Okay, number 6. It's about this time thinking, slightly similar but a bit different, that you must pick the perfect stocks. So in order to invest successfully, I believe that I need to be able to identify companies that have strong fundamentals and an attractive valuation. So it sounds, again, smart. It sounds like a good intention. And I'm under pressure because I really want to identify, maybe you can help me, Minna, the next Tesla or Apple. That's what I'm looking for.
Yes, I mean, this is about kind of picking stocks, right? So trying to, through analysis, right, understand which are the companies that will perform better and invest in them. This is possible, right? You can do that as well if you have the time to do it and you have a kind of systematic approach how you do it. But I just want to clarify that it's by no means required. No. Index investing allows you to invest in a basket of companies across different countries and sectors, right? It's a reliable and accessible way for most people to grow their wealth steadily, and you don't have to have a perspective on which companies will succeed or not. And that's a great way to invest for most of us.
Yeah, great advice. I love it. And last one, rule number 7. It's about overestimating our intelligence. We do that sometimes. So believing, for example, that I'm smarter than the market. I don't need to learn. I know it already. I can trust my instinct because I know what to do.
Exactly. Yeah, we humans are like that. It's very common for us to actually overestimate our own abilities, so that we are the ones who can really take the smart moves here, who can know what's going to happen. And this kind of overconfidence often leads to also over trading, right? So trading more frequently, buying and selling. And as a result, you actually have more transaction costs and very often also lower investment returns. So yeah, staying humble, being open to learning, grounded to the basics, right? That's what actually improves investment outcomes.
Yeah,
Yeah,
and
so
not
those
display at the same time, right? I mean, it will be different personalities also that are picking up different of these ways.
That is true. So these were the lose your money rules, right? So hopefully you'll remember this as the opposite, right? What not to do, right?
And in fact, the antidote to these behaviors, calm, consistency, diversification, humility, these are exactly what can build the lasting results. They're less exciting, but they're more effective, if I understood you correctly, Minna.
Exactly. These are all very much research-backed insights. We humans have certain biases, right? How we operate, thanks to also our evolution and how our brains work. And that doesn't always work that well in the investing world. So why don't we jump into this, right? Sophie, our topic 3 on the psychology of money.
Yes. I'm going to pull the banner for us here.
Yes. And by the way, if anyone has any thoughts on these principles of investing, have you felt that they work for you or that they don't work for you, or you find it difficult, or if you have any questions, feel free to use in the chat and we can respond.
We can address them as we go. So a few words on the psychology. I mean, I couldn't resist. Obviously, I had been speaking along as you were describing the principles. And I think we don't want to be repeating too much here, but indeed, there are a lot of these behaviors that are deeply psychological. I mean, what is not, in a way. So what we know, and of course we've been reading about it, but still in a way it's not really how we're taught about finance, is that a lot of investing successes or mistakes are built on what is happening in our minds. Also our emotions is not necessarily just what happens in the Excel spreadsheet that decides ultimately what happens.
Exactly. It almost feels like we are sometimes our own worst enemies when it comes to investing. Yes, and would love to hear also from people online. Has there been some challenges that you have felt with yourself? It could be also, by the way, about not getting started with investing, right? That's another potentially psychological hurdle as well. Let us know.
So we mentioned at the beginning this book that we've both read, Minna, and that can be an easy read on the psychology of money. So it will put you in this atmosphere of seeing already how big an influence our psyche has on our financial success ultimately. And Morgan Housel, he shared a few tips at the end of the book, which I particularly appreciate. So we took 4 of them here to illustrate a little bit what we were talking about. In a way, there are 4 principles. And the first one is about your sleep at night money, so that you can maximize, not necessarily your return, but let's say your results, what your results should be for you. And the goal is not necessarily to actually win the highest return, and that's what is interesting. It can be really individual what people want, but here what we're talking about with sleeping at night is how much emotionally are you ready to go through so that you can get the results that you want. And it's very important because you need to design a plan, an investing plan, an investing philosophy, whatever we call it, right? A strategy that matches our emotional capacity. So it's not necessary for everyone that what will keep them sleeping at night is that their money is invested into something that will bring the maximum return, but it might be. Some people will be really embarrassed if this is not the case and they won't be sleeping at night. So the sleep at night approach is really about that. It's about choosing something that helps you feel comfortable with regard to your emotional approach. And we wanted also to invite a thought, because we see a lot of people may have anxiety or a lot of reactivity when things get not necessarily under control. And to remember that your portfolio, that your investment portfolio is here to serve you, not to stress you out. So that can also change your emotional state and your actions.
Definitely. If your investment strategy makes you feel very anxious or like makes you lose your sleep, it's definitely time to review it, right?
Totally.
And then let's go to the second one. Time is your greatest asset. Of course, this one we talked about how difficult it is to time to market, right? But of course, yeah, what you can control is time in the market, right? And Morgan Housel indeed calls time the most powerful force in investing, because it lets little things grow bigger, right? And also allows some mistakes, the bigger mistakes even, to fade. And this principle, of course, applies to your investment strategy as well. So if you have some money that you need in the short term, in the next year or two, the stock market is likely too volatile for those kind of investments. So you need to have kind of enough reserves in a way that you can use, stay calm, wait out these kind of stock market downturns without having to touch the core of your portfolio, right? So this is in a way, with positive psychology, aligning with kind of cultivating future focus, and hope, right? So that we know, which we know are very strong predictors of psychological well-being.
Indeed, and we want that well-being, right? So another one is about how we keep ourselves anchored and okay, even when we are making mistakes. So the third advice is about it's okay to be wrong often. And I really like that one, because what we need to realize is, of course, we're diversifying, we're trying out new things, we're monitoring as we go. So of course, you will get it wrong sometimes, and that's okay. So we need to be able to tell ourselves that in a way that's constructive. So it's about compassion, and it's also about being open to learning. So most portfolios, they will maybe have a few standout performers and then a lot of things that are not really going well. And that's okay, because what matters is more the big picture. So it's important to try, for our own sakes, to stop sometimes the negative spirals when we're seeing or over focusing on the mistakes that we make because of the nature of investing. And when you're able to help yourself also with the cognitive work on telling yourself certain thoughts and working on them, it's part of the game. I'm following my plan. So you're helping yourself to go through with what is your intention. You will feel completely different. You will be able to act in a way that's much more aligned, much more conducive to being, to feeling happy and, fulfilled in your strategy.
Yeah. This is important now, especially when there were some of these big movements in the market. So if you did react quickly and you, for example, did sell something, yes, maybe it wasn't the optimal thing to do. Now you're learning from that. It's not a catastrophe for the long term. Let's keep focus on the future, right? And accept it that even I think all great investors make mistakes sometimes, absolutely, and it's just part of it as well, right? So that's it. And then the last one, as we are coming to the top of the hour, is define your own game. So it's important to connect to yourself, right? Just because someone else is investing in real estate or in crypto or in whatever, it doesn't mean that you have to do this. So this is about authenticity, key principle in coaching and positive psychology, right? What we have seen is that if you have self-determined financial goals, that leads to much more sustained motivation and greater well-being than an externally driven motivation. So if a financial advisor tells you to do this and this and that, maybe you hear some of it, but if it's you yourself kind of defining your strategy, your plan, it's so much more likely that you will actually stick to it and you will own it, right? So ask yourself, whose game am I playing? And is it actually, my game? And it's only you who will really care about yourself the best, right? In the best way, not anyone else.
Amazing. So all these insights, right? And the markets may be uncertain, but our inner compass doesn't have to be necessarily. And the more emotionally grounded we are and we are able to remain, and the more resilient the strategy is becoming.
Absolutely. Exactly. This is the mindset shift that we want to foster. It's not about having a financial plan. I mean, that's good as well, but it's also being the kind of person who can stick to it, even in the stormy weather. So that's the second part.
Amazing.
So we're coming to the end. Thank you so much for being here with us. I hope you found it valuable and interesting. Stay invested. Join, of course, in our next conversation as well. We really love to keep the community engaged.
Yes, and a few words as well. I mean, we're going to have a few live events for the community.
Yes. Sorry, I put the slides off too soon. There we go.
These are just a few words for those of you who are interested. We are planning some special in-person events in Luxembourg and also in Switzerland. So we're going to have something probably Luxembourg in the end of June, and then in Switzerland sometime in September, right, Minna? And
yes.
We're going to make it really exciting. I mean, we're at the moment designing it. But if you're interested and you don't want to miss and you want to make sure you're informed on time to register, scan the QR code here so you can join the community. And we're going to announce it there when we have the contours that are a bit more fully firmed. And also, our 5 months Wealth and Mindset Academy for Women, the Flourish Financially program, is now open to register your interest. We're gonna start it again in September. So if you're interested and you want to know if this would be a good fit for you, please drop us a line and we're more than happy to have a quick exchange with you, explain to you how it works, what's in there, and of course exchange on your specific situation, because we believe that it's very important to get this clarity on what could be the next steps. So maybe this is it, and maybe there's something else as well. So yes, thank you so much.
Thank you so much for being here. Take care. See you very soon as well, and let's keep in touch.
Thanks a lot to the audience as well, and we hope to see you around for the next one.
Exactly. Right. Thank you very much.
Thank you, Minna. See you. Bye-bye.
Bye.